What would happen if the world's economy collapsed? If we went back in time to the early 1930s, we'd see mass unemployment, people living off of soup kitchens and bread lines, and the most influential economic event in the history of the world, the Great Depression. But have you ever noticed how similar it is to today? The year was 1929. Stock prices were rising steadily all throughout the decade. People believed that this would last forever, and they began borrowing heavily to invest in the stock market. The wealthiest 1% owned more wealth than the bottom 42% of the United States. Banks issued loans to these investors, and even to regular people who wanted to buy homes. But the Federal Reserve was concerned about the rising prices. It raised interest rates several times in an effort to cool down the economy. And as interest rates increased, people couldn't afford their homes and began defaulting on their loans. On October 29, 1929, the worst single day in the history of the stock market, commonly known as Black Thursday, stocks fell 12%, wiping out billions of dollars in wealth. After years of rising stock prices, people finally realized that the economy wouldn't grow forever. In today's world, things are looking pretty good on the surface. Unemployment is low, wages are rising. In America, at least, everyone is going back to work after the pandemic. But underneath the surface, we're seeing record inflation, supply chain shortages, and the highest national debt in the history of the United States. We've been hearing for months that inflation is transitory, but it looks like it'll be around at least until the end of 2022. Just like the Roaring '20s, the decade before the Great Depression. Our decade has seen tremendous growth and innovation. We've seen the rise of smartphones, electric cars, streaming services, ride-sharing companies, self-driving technology, cryptocurrency, and the list goes on. Many people have become accustomed to this rapid technological advancement and believe that it will never end. Just like the wealthy investors of the 1920s, people have become overconfident in their investments. The S&P 500 is trading at a price-to-earnings ratio of 30, which means that companies in the index are trading at their most expensive level in the history of the stock market. And let's go back to those rising interest rates. In the early 1920s, the Federal Reserve was concerned about rising stock prices, so they raised interest rates. Today, the Federal Reserve is also concerned about rising stock prices, not to mention inflation. So they're raising interest rates again, just like in the 1920s. This is already leading to a housing crisis in places like Canada and the United Kingdom. As interest rates rise, fewer people can qualify for mortgages and housing prices fall. But there's one thing that we haven't seen yet, a major crash. For that, we'll have to go back in time once again to the year 1931. In the first few years after the stock market crash of 1929, people didn't lose faith in the stock market. But everything changed when the market bottomed out in 1932. And in 1933, people lost faith in the banking system when President Franklin D. Roosevelt announced that the nation's banks would be closed until further notice. People immediately began withdrawing their money from banks, but they were too late. Banks didn't have enough cash on hand to give everybody their money back. And without the backing of gold, there was simply no way that they could come up with the money. On March 6, 1933, FDR signed an executive order that made it illegal to sell or transport gold coins. Gold bullion or gold certificates, unless you were a government agency or had permission from the Treasury Department. The U.S. went off the gold standard to allow the government to devalue the dollar and increase the money supply. This led to hyperinflation. Between 1930 and 1933, the price level nearly doubled. By 1933, 1 out of every 4 Americans was unemployed. Soup kitchens and bread lines became a common sight across the country. People were losing their homes, and the federal government did very little to help them. From 1930 to 1933, industrial production declined by 45%. GDP fell from 100 to 56. At the height of the Great Depression, the leader of Germany was desperate for a way to improve his country's economy. Hitler promised the German people that he would make Germany great again, blamed the Jews and other political enemies for the country's troubles, and promised to restore the German economy to its former glory. Under his leadership, Germany would rearm and become a powerhouse of the European continent. During the Great Depression, many countries turned to fascist dictatorships because they offered simple solutions to complex problems. In Italy, Benito Mussolini promised to bring Italy out of the Great Depression by building infrastructure. He set out to build roads, bridges, buildings, and anything else necessary to make Italy great again. In America, President Franklin D. Roosevelt worked tirelessly to solve the problems facing the American people. His plan consisted of 3 parts. The first part was relief, which involved providing jobs and food to those in need. The second part was recovery, which involved ending the decline in the economy and creating jobs. And the third part was reform, which involved changing the way the American economy works. These reforms included creating the Social Security Administration, the Federal Housing Authority, and the Securities and Exchange Commission. But what really ended the Great Depression was World War II. For years, people have debated whether World War II was really necessary to end the Great Depression. We know that the war helped America and many other countries get out of the Depression. But was it necessary? Fast forward to 2022, some economists believe that the only reason that the U.S. has unentered a recession yet is because of the stimulus checks that were sent out during the COVID pandemic. Without this extra money, the U.S. probably would have entered a recession in 2020. But what happens when the government stops propping up the economy? What happens when stimulus checks run out? What happens when the stock market crashes? If we take a look at the causes of the Great Depression and compare them to today's world, we can see some pretty obvious parallels. Both the U.S. in 1929 and the U.S. in 2022 saw rapid growth and prosperity in the years leading up to the crisis. Both saw rising stock prices and falling interest rates. Both saw wealthy investors taking big risks with borrowed money. And both saw ordinary people buying homes with cheap loans that they couldn't afford. We can also see some interesting parallels between the world today and the world in the 1930s. Both worlds have seen periods of deflation and inflation. Both worlds have seen healthy economic growth and devastating recessions. Both worlds have seen widespread unemployment and a growing middle class. One of the biggest parallels between today's world and the world in the 1930s is the role of banks. In both worlds, people put their trust in banks and financial institutions. In both worlds, these institutions failed and caused widespread economic damage. Another interesting parallel is the role of the federal government. In both worlds, the federal government did little to prevent the economic disaster. In both worlds, the government took over banks and other financial institutions. In both worlds, the government created programs to help the poor and unemployed. But there's one thing that we haven't seen yet: a major crash. The stock market has been on a wild ride recently, but it hasn't crashed yet. If it does, we could see a repeat of the 1930s. People would lose faith in the stock market and the government. Banks would fail and unemployment would skyrocket. This isn't just a theory. There are plenty of people who are predicting a repeat of the Great Depression. In fact, there are people who are saying that we're in the Great Depression right now. So what can we learn from history? First, we can see that the economy doesn't grow forever. Eventually, there's always a downturn. Second, we can see that bad investments can lead to economic disaster. Third, we can see that overconfidence in the economy can lead to disaster. Fourth, we can see that rising interest rates can cause a recession. Fifth, we can see that bank failures can cause a recession. And sixth, we can see that governments don't always prevent recessions. In fact, sometimes they make things worse. What will happen to the world economy? Only time will tell. But one thing is for sure, we're in for a wild ride. If you enjoyed this video, please leave a like. It helps me out tremendously. And also, if you made it this far without spilling your coffee, you officially deserve to subscribe. Your curiosity and your caffeine addiction will thank you. Thanks for watching.